The conflict in Iran has added some strength to the Canadian dollar this week. Let's start there with Sarah Ying, head of FX strategy for global markets at CIBC. Thanks for joining us today.
Yeah, absolutely.
Where is that strength coming from for the Canadian dollar?
So there's a couple of things. The biggest thing is that oil prices have been rallying since the conflict started, and usually, most of the time, the Canadian dollar and oil prices after the 2014 terms of trade shock hasn't really responded much. But when you do have such large moves in oil prices, the Canadian dollar definitely starts to listen. And that's where most of the rally and the gain and the strengthening of the Canadian dollar is coming from.
OK, so I know you referred to this as a first phase. What happens next?
So generally speaking, when it comes to geopolitics, I actually think the first phase is really that risk-off move. The market gets a little bit panicky, and then you start to see a haven bid to the US dollar. So this kind of risk off hasn't really been very long in the market this time around. Usually in past events, it's lasted about 2 weeks. Now it's been a couple of days. And one of the reasons why is because the rates market is really keen to price in that inflationary risk. And that all stems back from oil prices moving higher. And this is one of the best weeks for oil prices ever, which is why the market is so quick to respond to that kind of inflationary shock.
Okay, so once the uncertainty fades, and we don't know when that will happen, and we're speaking here about the uncertainty that has to do with the Middle East conflict as opposed to others, you say absolutely. Then the dollar could sharply pivot lower again. What would that trigger look like?
One of the things is the de-escalation of the conflict is probably going to be the major trigger. Another possible trigger would be if, let's say, the U.S. data is meaningfully deteriorating. We did see a not so great non-farm payrolls report today. So if we do see the data kind of worsen a little bit in the US and the Fed has to ease a little bit more quickly, that may cause the market to pivot from trading kind of buying dollars to selling dollars.
Okay. Recap for me what happens if oil does stay elevated. We looked at how much it shot up this week, and we know that's quite a record for oil for recent history. But if it does stay elevated, and at what level would you see the U.S. and Canadian dollar fall back?
I think there's two things here. One is how quickly oil can rise, and the other one is how long it can stay elevated. If it finds some equilibrium, you probably see markets start to ease up a little bit on inflationary expectations. That is actually a more benign outlook for dollar Canada. In that scenario, maybe we see low 135s, not so much kind of far away from where we are now. I think the biggest risk if you do see oil kind of rally a lot quickly. And if we do see that in a very near term, you can see dollar CAD testing around 134. So that's really kind of the base that I'm looking at.
Okay. Investors are always looking to benefit one way or another. How could they benefit from the strength in currency?
Yeah, absolutely. So one of the biggest things that investors can do is to go long the Canadian dollar on crosses. So, for example, going short Euro CAD is definitely a trade that is in vogue at this time. The European Union, they probably are going to get hurt a little bit from higher energy prices and higher natural gas prices, whereas Canada stands to benefit from those moves. So that's a trade that we like. So going long Canadian dollar against different other currencies.
Okay, so what are the other commodity-linked currencies like Canada?
So the Norwegian krone is another one, but these days, I think that the Canadian dollar is seeing a lot more impact for a couple of reasons. One reason is that over the past, call it several quarters, the carry trade was very much in vogue. That's where investors went long emerging market or higher yielding currencies. And one popular funding currency was the Canadian dollar. So a lot of investors were short the Canadian dollars going into the conflict. So that's why we see a lot more impact on the Canadian dollar versus other commodity currencies.
We talked about sectors like energy benefiting from something like the war in Iran. I'm wondering what sectors are at risk if the loonie stays elevated.
A lot of the sectors that are at risk are sectors that have higher input costs, some things like discretionary, maybe industrials, staples to some extent. Those are the types of sectors that probably are hurt a little bit more. More of these traditional high margin sectors, such as tech and obviously energy, stand to benefit.
Okay, I'm going to leave it there with you, Sarah. I appreciate you joining us on the program today. Sarah Ying is Executive Director. She's with Strategy for Global Markets at CIBC. Thanks for joining us.